Welcome back, ladies and gentlemen. For the next session, we'll be having Mr. Sulesh Kumar from MEDICI. Sulesh is a strategy consultant who works on projects in fintech and banking. At MEDICI, he has been looking at strategic initiatives for both fintech startups who want to expand as well as financial sector players who want to better understand dynamics of fintech environment. He is very experienced in leading fintech research teams, and today we'll be showcasing about India WealthTech, what's been the growth opportunity, and some insights from the latest Medici report on fintech in 2020. Right. So, Sulesh, over to you, and thank you so much for joining us.
Yeah, thank you so much, Mushir. Thank you for the opportunity. Like Mushir mentioned, I'm a strategy consultant at Medici, part of the fintech research and advisory division. As you know, Medici is the one-stop platform for everything fintech on the internet. Uh, if so, we are going to start working on the India Wealth Tech report. As you're aware, the India wealth tech scene is at a very growth stage compared to the other markets in the US or the UK or even in Europe, where we have startups such as Betterment, Wealthfront, Wealthsimple, etc., which have very high AUMs. In India, the industry is still at a very nascent stage. There is a very young millennial population who are earning a lot of income and who are looking to save and invest. There are a lot of fintech and wealth tech firms who have started up in the last few years, say last 4 or 5 years, who are looking at an opportunity to tap into this young millennial population and their thirst for investment. Even if you look at the funding for the last few years, wealth tech has always been in the top 3 or 4 sectors for funding in fintech in India, along with lending, payments, and insurtech. I will start my presentation. Yeah. Before I start into the wealth tech sector in India, I would like to give a brief about what the Indian investor is and his demographics. So, if you look at it, we have 2 million investors in India in equity and 20 million investors in mutual funds. Mutual funds is the most popular form of fund investment in India. The 2 million equity investors are primarily in the two stock exchanges, that is the National Stock Exchange as well as the Bombay Stock Exchange. This is a very big addressable market, as we're looking at a lot of people who want to invest in digital means in these particular products in equity as well as mutual funds. Now I'll go as a small demographics. The Indian investor, 50% of the investors or new investors in India are young millennials. 62% of these millennials actually prefer to invest in SIPs, that is recurring investments, instead of lump sum amounts. 80% of these investments, millennials actually save only less than 20% of their income. Uh, this is something which the millennials are actually working towards. We can see that this is increasing, and as this amount percentage of investable income increases, it will be a more opportunity for the wealth tech firms to tap into. Another very interesting factor is 25% of the SIPs investments in India are actually cancelled in the first 12 months. Now, this is an indicator of a very short-term view of the Indian investor. If you look at the returns of mutual fund products versus what the investors have returned, you can clearly see that investors have actually got less returns than what the funds have returned during a 5 or 15-year period. It's very visible in these graphs that in each of these products, whether the equity funds, hybrid funds, or even debt funds, the Indian investor has actually returned less than what the fund has managed to return. One of the primary reasons is the volatility and the volatile nature of the Indian investor, who actually looks for short-term gains. One of the reasons which we have found for this is that, for example, in the US, you have products such as the 401k and the IRA, by which an investor is very much aware of where he's investing in and what returns he needs and the time span he needs for investment. We do not have similar products in India. As a result, the Indian investor is still understanding the equity products and will take time to understand that long-term outlook is more important than short-term gains. Now that we have understood the Indian investor, I would like to give you an overview of the wealth tech market. Yeah, the Indian wealth tech market is primarily divided into 5 segments. At the beginning, we have the robo advisory platforms. Now, these, as you're aware, these are platforms that give you a portfolio based on your goal as well as your risk appetite. We have the personal finance management platforms, which are mostly consumer facing. They're consumer oriented. They tell you about the best fintech products to invest your money in. We have some unicorns as well in this particular space. There's Pesa Bazaar. We also have companies like Bank Bazaar who are doing really well in this. We have digital wealth advisory platforms. Now, these platforms are at the other end of the segment. They target the high net worth individuals. And along with regular investing options, they also offer options such as estate planning, succession planning, family investments, tax planning, etc. So here, the investment amounts are larger and the ticket size is also larger. Traditionally, this sector has been more of offline, but now we're also finding players who are offering this particular segment exclusively online. Then we have the investment platforms. These are direct investment platforms that help you invest in mutual funds as well as other assets such as digital gold, for example. These platforms do not offer you any additional service other than the fact that you can invest in mutual funds and other assets. And finally, you have online brokerages, discount brokerages. Similar to Robinhood in the West, we have discount brokerages in India as well. Zerodha is a big example. They are a unicorn in India. The most biggest attraction of discount brokerages has been the fact that the platform is completely digital, and the investment is it's very easy to invest in these particular platforms. We have close to 500 WealthTech companies in India. If you look at it, we have a small logo wall showing some of the prominent players. In terms of WealthTech funding in India, 2020, the funding has been less compared to 2019, primarily because of the impact of the COVID pandemic. However, if you can see that we have 31 deals as compared to 18 deals in the year prior. So there is a lot of investor interest, and we are sure that this particular figure will continue to increase the next coming year as well. If you look at the major segments that are receiving interest from investors, you can see that 65% of the investments have been made in investment platforms as well as robo-advisors, and 33% of the investments have been made in personal finance management and aggregators. In the next few slides, I will go in depth into some of these segments and show you what is the main attracting reason for each of these sectors. Yeah. If you look at in India, for example, the brokerage sector, now discount brokerages are a phenomenon that has been gaining interest across the world. Like I mentioned earlier, Robinhood in the US has shown a tremendous potential for brokerages on a digital platform. In India as well, we have seen examples of companies like Upstock, Zerodha, and 5paisa are doing tremendously well as compared to their traditional brokerages. The COVID-19 pandemic has pushed a lot of people towards investing in equity. There could be multiple reasons. One of the reasons is the performance of the equity markets itself. For example, in India, today itself, the Sensex, the benchmark index for the Bombay Stock Exchange, has crossed 50,000. That's happening for the first time. And we were at 30,000 in 2017. In the span of 3 years, it is almost doubled. So equity markets have been performing really well, and a lot of Indians are now looking to enter this particular equity market. So a lot of these people who are investing in these discount brokerages are actually from tier 3 and tier 4 cities. If you look at the performance, Upstocks has actually had a 124% increase during the COVID pandemic. This is compared to users of March compared to users in October. So in a span of 3 to 4 months, they had a 124% increase in users. Zerodha recorded an 84% increase in users, and 5paisa recorded a 69% increase. The traditional brokerages haven't fared too badly either. We have seen around 20% increase in some of them. Most of the traditional brokerages are actually managed by banks. So we have Kotak, ICICI, as well as HDFC. However, the story of discount brokerages has been the story of the WealthTech sector during the pandemic. It's been very easy to invest in these particular digital platforms. The ticket sizes are smaller, as well as the fact that these are low-cost investment options. The trade value is very less. So it's an easier and a low-cost option to invest in equity. If you look at it, the next one, if you look at is investment platforms. We have investment platforms. I've taken two primary examples, Grow and Paytm Money. These two are investment platforms that help you invest in various assets such as mutual funds, digital gold. Paytm Money belongs to the Paytm Group, one of India's largest P2P payment platform. Paytm Money has done really well in the last 1 year. In 2019, they had 3.3 million subscribers, and now that's gone to almost 6.6. So they have doubled the number of users in the last 1 year. So is Grow. They have almost have a 4x growth in number of users. So this is clearly a clear sign that a lot of people are now wanting to invest in equity and other digital products, uh, primarily because of the spread of smartphone as well as the availability of the internet, which is enabling users to use these products on an easier option. Both Grow and Paytm Money also have started investment in equity. So they are now going to give competition to the discount brokerages like Upstock and Zerodha. Both are now actually offering investment options in equity. If you look at the robo advisory segment in India in 2013, we had only 3 robo advisors. That has now gone up to almost 20 plus robo advisories. This is a segment that's also seeing some sort of a consolidation. Last year, we had Neo actually acquiring an Indian robo advisory startup. The reason is that a lot of neobanks are coming up who want to offer services beyond the traditional banking services. So they're actually looking at established players in the robo advisory sector whose services they can use and offer to their neobanking customers. Uh, Again, we have seen some good numbers in terms of AUM and AUA. It's 2 billion for Kuvera, 675 million for Paytm. However, these numbers are obviously not comparable to the numbers in the US, but we are seeing a great and tremendous increase in these AUM numbers. If you look at the robo advisory landscape in India, it's primarily based on 3 types. It's fund based, equity based, as well as comprehensive based, wealth based. So again, the robo advisories are those that give you a portfolio based on your investment, based on your risk appetite, as well as your goals. Fund based are those that help you invest in mutual funds, ETFs, and other debt funds. Uh, Equity based are those that help you invest purely in equity products. So small case, for example, is a thematic investment platform that helps you select themes based on your appetite in investing. In comprehensive wealth, as I explained earlier, is towards the other end of the spectrum, targeting high net worth individuals. IND Wealth actually offers services like tax planning. Cube Wealth offers PMS services. Players like IND Wealth are also expanding beyond just robo advisory. They're also offering loan products, loans on your portfolio, personal loans, etc. So we can see a trend of robo advisors moving beyond just offering advisory services to actually offering a super app that covers various financial products and services. If you look at the collaboration in the Indian ecosystem, there has been a lot of collaboration between banks and well tech firms. A lot of traditional banks, for example, the Bank of Baroda and the Oriental Bank of Commerce, who are traditional PSU public sector banks owned by the government, are actually approaching Indian well tech firms to offer investment platforms for their customers. A lot of these banks depend upon the technology of these fintech firms to offer investment options for their customers. The same has been seen across multiple partnerships between banks and fintechs in India. At last, I would like to just give a brief overview of what are the driving factors and what led to the growth of wealth tech in India. The number one is the investor awareness and prudence, which has been primarily because of the COVID-19 fallout. Because of COVID-19, we have a lot of people working from home and who are looking to look at different avenues of income and investment. This has been tremendously seen visible in the equity investment market. The next is the entry of new AMCs into the market. A lot of these Indian wealth tech startups who are offering brokerage services are now looking at the other end of the spectrum where they want to offer their own mutual funds. This was not possible earlier. However, SEBI has now issued a new license, and most of these, a lot of these Indian wealth tech startups will be offering their own mutual fund products. Another very important factor which has contributed to the ease of investing or for consumers is the ease of onboarding and operations. As you're aware, India has the Aadhaar for digital identity as well as a DigiLocker for digitally storing your documents. This has made it very easy for the Indian consumer to use these particular investment platforms. It's very easy to for your KYC, for uploading your documents, as well as it's become easy for firms to onboard customers very easily. We have something called as the account aggregation as well. In account aggregation, it's very easy for consumers to link their various bank accounts and they can have a better picture in their investment platform. We also have ease of onboarding norms. As I just mentioned, it's very easy for customers to onboard on these platforms, as well as easier for firms to get new customers. We also have ease of enablement of payments as a backbone. So in India, as you're aware, we have UPI, which is a P2P payment platform, which has almost seen 2 billion transactions every month. UPI has also now launched direct debit as well as recurring payments, which enables investors to have periodic investments in various products. And finally, SEBI, that is the Security and Exchange Board of India has now offered fintech sandboxes where WealthTech firms can actually try out their products in the regulatory landscape. So, in overall, I would like to say that in India, we have seen a lot of growth in WealthTech. However, it's still a very nascent market. The spread of mobile phones and smartphones have enabled users to adopt these particular investment platforms a lot more. A lot of users from tier 3 and tier 4 cities now want to be part of this growing equity market and its growth. So, you can see that the Indian investor, the Indian equity, and the WealthTech market, all three will now benefit greatly from the growth of digital revenues in India.
Great. Thank you so much, Sulesh. That was really, really interesting and insightful. India's economy is very well poised. As you said, we only have 2% quite actively engaged in wealth management of wealth services. And hopefully, as that grows with the economy's target of 5 trillion in the next few years, we will see a growth in this area. So, once again, I would like to thank you and MEDICI for this presentation. Audience, we will soon be starting the next session, which will be focusing on Wealth Connect and the Greater Bay Area. So, moving from one Asian giant to the other and more closer to home for all of us. So, thanks again, Sulesh. And for the audience, just please wait for a minute and we'll start the next session soon. Thank you.